If I were to ask you how many categories of money are there in your business, what would you say? Would you say one? It's all money. Two, three? Actually, there are 10 categories of money that you need to pay attention to in your business. And what I've found for most entrepreneurs that I talk to, especially those that are creatives, quick starts, the high quick starts on the Colby, we just want to create. We just want to sell. We just want to write copy. We want to build landing pages. We want to speak on stages. We want to write books, so on and so forth. We just want to do that fun stuff. And we don't want to pay attention to the numbers. And that's where business owners and entrepreneurs get into trouble because they don't run a profit and loss. They don't understand the numbers and these categories of money. They assume somebody else is doing it. Their CPA's got it. Their bookkeeper has it. And the truth is, nobody cares about your money as much as you do. So you have to care about the money. And your desire is to count every dollar and to start to understand how money works. The problem is we think this is hard, or I'm not a numbers person, or I'm not an accounting person, and I don't like to do all that. But actually, it's pretty simple. And once you start to do this, it gets addictive because your money's addictive. You're working so hard for it. So why wouldn't you want to get good at the money while you're getting good at everything else? All right, so let's break down these 10 categories. The first category is what we all more or less pay attention to, and that's called revenue. And revenue is, we know what revenue is. That's the money we make in the business from selling our products and services. So that's all the money that comes into the top of our business account. Revenue. Now there's the master category of revenue, and then many our businesses will have several revenue streams. And it's important to track those different revenue streams because you want to be able to assess, like, where's most of the money coming from in my business through the products, through the sales of what products. So for example, in my business, Wealthy, we have one program called Curbs, and that's the personal finance course that teaches entrepreneurs how to build wealth and create financial freedom. And that's one that's one product that we sell. So on my profit and loss statement, there's a line item under revenue that says Curbs revenue. There's another product that we sell, which is called Curbs for Business, which is our business finance and our business in a box program. So that we go sell that, and then that all the sales revenue comes and is tracked in what's called Curbs for Business revenue. And we have 6 or 7 revenue streams in Wealthy, each have their own line item. So usually when you're starting, you have one, but the idea is that you want to be able to track all your different types of revenues even, so that you can say, hey, this percentage of the business income or revenue came from this product and this percentage came from that product, and it just helps you become a smarter business owner so you can make the types of decisions you need to make based on what your numbers are telling you. So category number 1 is revenue. Category number 2 is called cost of sales or cost of goods sold. I think most of us listening to this YouTube channel, we're service providers. So we're entrepreneurs that are coaches, independent contractors, 1099ers, more self-employed, but we're probably building service businesses. We're not building a product company per se, although it works the same. But the idea with cost of sales or cost of goods sold means that there's a cost attached to every unit sold. And that is money that actually is not your money. It doesn't belong to the business. And this is a really important distinction to understand because it makes a difference in how you spend your money and what's going to be left over. So for example, a cost of sale for Wealthy is one way that I market my products and services is through what's called affiliations. And affiliation means I have these JV partners, for example, and they're marketing my product to their audience. And if one of their audience or customers buys from me, I pay them what's called a referral fee or an affiliate fee. So that means, in this case, if I were to generate $20,000 of revenue this month from all the sales, and let's say I pay out a 10% commission on all those sales, that means $2,000 is going to come out basically immediately. So even though the company made $20,000, we actually kept $18,000. We didn't keep the $20,000. So it's very important to watch this number. Now, if your affiliate fee was 20%, in many marketing, like internet marketing businesses and others, and when I owned a real estate brokerage, for example, I would collect all the money up top, and then I would pay my agents a 50% referral fee for, what they got their commission back. So in that case, it was $10,000. So that is you're going to see how this can be a difficult model from a financial standpoint, because what happens is even though I brought in $20,000 worth of sales business, I had to pay out 50% and only got to keep $10,000 of the $20,000. And that brings us to the third category of money, which is called gross profit. And that's what gross profit is. Gross profit is revenue minus cost of sales. So you can see businesses that have a high cost of sales, they keep much less money than those that have a low cost of sales. And that's why when I had a big real estate brokerage, it took me a while to really understand, why am I selling $100 million worth of sales, and at the end of the day, I'm just not keeping that much money? Well, a big portion of it was because my cost of sales was so high, and that's part of what happens with a real estate business that functions off this type of model. Even in real estate, sometimes they're paying out commissions like 90%, so they're only keeping 10% as gross profit. But anyway, the thing is you need to know what is the standard for your type of business and industry, and make sure you're meeting or beating that. It's a good way to evaluate if you're too high or too low. So that's the third category. Now the fourth category is called operating expenses. And your operating expenses are how much does it cost on a monthly basis to operate your business, independent of any sales? So you need to know that number. I call that number company burn. So if my business in this example, let's say the burn rate of cash is $5,000 per month. So that means I'm paying out 50% or $10,000 towards all those referrals that have helped me some form or fashion hit this number. And now every single month, for the most part, the company expenses are $5,000. So now that means I'm going to burn this $5,000 whether I generate $1 of revenue or not. What that means is that we want to really know what this number is, and my recommendation is we want to keep it really tight. We want to have a really nice, mostly fixed burn rate so that we can predict, what that money out is going to look like. And so it's really important to pay attention to this. I'll put a link to one of my other videos that says how to make $10,000 more in your business today. And when I start working with so many business owners where everybody else is saying, hey, make more money up here. I can teach you how to make more money, more revenue, go from $10,000 to $20,000 a month. And where I start with my customers, I bet you I can find $10,000 for you today, but you don't have to spend the money or more time to sell more unit. I'm going to find you $10,000 by showing you how you're not paying attention to your expenses and how money's just evaporating out of your business. But the fourth category here is operating expenses, which takes us to the fifth category, which is called profit. Net profit before taxes. So this is gross profit and this is net profit. And in this case, I would have $5,000 left over as profit, and that's what I, as the business owner, get to keep. So to look at this again, I say this all the time, is that when you're being sold these programs, I can teach you how to make $20,000 a month. Our thinking is I'm going to put that $20,000 in my household account, and I'm going to go from $6,000 a month working for corporate America to $20,000 a month. Who's not going to sign up for that deal? But what they're not telling you, they're selling you on top line, and they're not selling you and telling you the truth about bottom line. So you need to know, what is the average net profit margin for my type of business? And then to understand that there's a big difference between $5,000 and $20,000. So 20% profit margin which is, like I said, it's a big difference. Now, 5 categories. All of these categories are in something called a profit and loss. It's a profit and loss. That's the financial statement, and it's really important, even if you're just starting out, to start running a profit and loss and get in the habit of it. But every month, I'm writing a profit and loss more than once a month. But at the end of each month, I'm really looking at all of these master categories and drilling down to see how every dollar is being made and being spent in the business. But it's really important that you get used to a profit and loss, you track your numbers. In order to do that, you're going to need QuickBooks Online or an equivalent type of software system. But these are these 5 categories that are represented on what's called a profit and loss. Pretty simple, right? There's no rocket science here. I mean, everything I just explained, I think, is really simple to understand. So again, you're afraid of something that's not that, there's nothing to be afraid of. All right, so number 6 is something called assets. Now, we're talking about the profit and loss. We're moving over to here, something called a balance sheet. And your balance sheet is, what's reflected on your balance sheet is one of the first thing is called assets. And assets is anything your business owns that has value, that has some type of value that can be represented on the financial statement. And you want to know what are the assets of your business. And the idea is to grow assets basically over time so that ultimately what your business is going to have is a higher what's called enterprise value, and something called your owner's equity is going to go up. So balance sheets are a little bit more complicated to understand. I mean, the profit and loss is pretty obvious, but as small entrepreneurs, small business owners, we're not thinking in terms of assets. But if we want to build our business and we want to have more money and we want our business to have more value, it's reflected in something called assets. Now, assets can be equipment. Assets could be maybe if you're in real estate, you own a car that's on your books, your business books, or it could be a building if you own a building. Those are more obvious types of assets. Where I find the entrepreneurs make the biggest mistake is there's something called accounts receivable. And accounts receivable, an example of that, so of all the programs that I sell, you can pay for my programs one of 2 ways. 1, you can pay cash up front, or 2, you can do a payment plan. So let's say you're on a payment plan that's $2,000 a month, as an example. So, well, actually, let's say that my business program, which this is true, my business program at the moment is $10,000. $10,000 for a 6-month program. And so $10,000 for a 6-month program. I was trying to, in my head, keep the math easy. But if you don't pay the $10,000 up front, I have a payment plan that you can pay $2,000 a month for 6 months. So if you want to break it up to payments, then you get to do that. So what you do is my customer would spend $2,000 in month 1, but then they own $10,000. They still owe me $10,000. I'm charging a premium for that payment plan. That's kind of the interest on being able to spread it up over 6 months as really incentive to have people pay cash up front. Because as a business owner, you want to collect cash up front if that's possible. But then you give the option for those that want to spread it out and pay a little bit more to do so. So now what this means is that on my balance sheet, there's something called an asset that means I still am going to collect $10,000 in the future from this customer and all others that are on payments plans. So part of what I'm doing is that when I'm looking at my profit and loss every month and it says maybe I made $5,000 in this example, but I can also see, I can predict that I'm going to have the same $5,000 coming for the next 6 months if all those numbers more or less stay the same. So again, it's really important because you want to see how much future business do I have coming in? But again, I look at books all the time and so many small business entrepreneurs aren't tracking the fact that they have accounts receivable. And one, you don't know how much money is coming in the future, which is really nice to know. But two, it's practically impossible to stay on track to make sure that all of those customers that are on payment plans are actually paying. So we keep track of like, okay, everybody that's completely on track for their payments. Oh, those that are 30 days late or 60 days late or 90 days late. So, and you can track all this on QuickBooks and the different things, but that's part of being a business owner. You want to be able to look at these things and think, we have a lot of people on payment plans and they're not paying. That's not something you want to happen in your business, and that means we have a problem we need to solve. So that's assets. The seventh is called liabilities. And liabilities is your business debts. And that's just everything you owe to other people. Not a lot to say here. Again, pretty obvious, but if you own a building and you have a mortgage, that's going to be a liability. If you have a car and you have whatever the loan is on your car, that's going to be a liability. And so those are the more obvious ones. The mistake that I see most entrepreneurs make that I work with is that they loan a lot of money to their company. So they're putting money into their business to fund their business, and then the money just gets eaten up by the business because the businesses love to eat money and eat up all your cash. And they're not keeping track that, hey, I, Christina Wise, as my personal person over here that has, let's say, $10,000 sitting in an account of cash over there, and my business, I want to put $10,000 in my business, that $10,000 then should be tracked as a liability on the books, meaning this $10,000 is a liability on Wealthy's books, but it's owed to Christina Wise, and this becomes an asset on my household books. So this is a whole game that I teach to how to really maximize, how to use your business, use you as a lender to your business, and use your business to pay you back more money, and all sorts of ways to make more money necessarily without having to sell more units. And you can do all this by knowing your numbers. But it's really important that if you're loaning any money to your business, that you keep track of it as a loan or reflected as equity. All right, so that's number 8. And that's number 7. Number 8 is something called cash. And cash really is an asset, so it shows up as an asset in your business, but I like to separate it because it's really important that you have cash in your business. And the reason why, the number one reason why businesses fail is because they run out of money, and therefore you need some cash. It's called retained earnings or called reserves. And I recommend to all of my business owner clients that they keep at least 3 months cash sitting in the business is kind of that business rainy day fund, if you will. And you might have other cash departments. I have recommendations on how to split cash and how much cash to leave in your business. But the idea is you need some cash sitting there that's just cash for the business. But here's the caveat. The other thing that I see is businesses that have too much cash that they leave in the business. In fact, I did a consultation with a client earlier this week, and his name's Matt, and Matt said, hey, I need your help. Would you help go through all of my balance sheet and see if you have any recommendations for me? So when I looked at all this, he has a lot of cash. He's doing great in his business. And I said, first of all, Matt, congratulations. I love seeing all this cash here. And the second thing is you've got too much cash in your business. So we're going to move this cash out. I'd like you to move this one over here and do this and do that. But ultimately, I want you to pay yourself about $75,000 of that cash sitting there so that we can invest it and do some other things. So sum all that up. Usually when I see way too little cash in the business or none at all, or oftentimes way too much. And so just to know that there's a sweet spot. All right, the next thing here, number 9, is called owner's equity. And the simple thing for owner's equity, it kind of goes like this. It goes assets, liabilities, owner's equity. So in accounting terms, it doesn't really work this way, but your owner's equity is really your assets minus your liabilities. And it's kind of the value that your books give to the business. And it goes up every time that you, every time there's profit, it goes down anytime you take money out of the business. But it's really a measure of assets versus liabilities. So if you don't really have any assets in your business, but you have a lot of liabilities and debts, your owner's equity is going to be low. But we want it to be the opposite. So we want to increase what's called this enterprise value of the business. And that means that we have a lot of assets. We have a lot of valuation on the books relative to the debts, which means we have higher equity value. And that's what we're doing over time in our business, is we're really building that owner's equity so that we know how much we have invested in the business and how much it's worth, and all of that on what's called our balance sheet that reflects that owner's equity. All right, so owner's equity. And then the 10th thing is called cash flow. So your assets, liabilities, and owner's equity, and like I said, cash is a part of the assets, but I just like to separate it just to make that point. But all of these are part of what's called your balance sheet, your business balance sheet. And that you're going to look at your balance sheet. So I'm looking at my balance sheet every month, really look at those accounts receivables. How am I doing as far as growing the business as part of the equity value? How am I looking to pay off those debts? Because there's always debts on the business books in most cases. And really saying, hey, how is my business valuation growing kind of month over month and year over year? So that's the balance sheet. And it's just a really important financial statement to learn and understand, again, to help you make good decisions in your business. Now, the final one here, number 10, is called cash flow. And it's reflected on what's called the statement of cash flows, which is another financial statement. And where I see business owners, maybe they're pretty good with their profit and loss. Maybe they're okay with their balance sheet, but they're not looking at what's called a cash flow statement. And a cash flow statement is really important to pay attention to, because it shows you how much, within a certain period of time, how much cash is going in relative to how much cash is going out. And it's important because this profit and loss and this balance sheet can get a little confusing, because you might show that you made $5,000 revenue, but then you're wondering why you don't have $5,000 cash left over. And it's because how things are reflected on the financial statements, where, yeah, you had $5,000 of profit, but maybe you only have $3,000 of cash sitting over because you made a $2,000 principal payment towards a loan that's reflected on the balance sheet and not on the profit and loss. Don't want to lose you. But I find so many entrepreneurs will say, I don't understand why my profit and loss is saying I made $50,000, but I have $10,000 of cash. So again, all these financial statements are tools that you use to know exactly the state of your money, how much money you're making, how much money you're spending, what these different percentages in, like gross profit margin and net profit margin, how my equity value is growing, how my assets are growing and my liabilities are going down, how much cash I have sitting in the bank, because that cash feels really good to be sitting there. That means that, you know, we're pretty healthy, and that cash is flowing the way I want it to flow. All right. So I know that's a lot in one video, but I just want to break down these 10 categories and really inspire you to get to know your numbers and get to love every dollar in your business, track every dollar, pay attention to every dollar, and just desire to be the owner of the financial system that is that part of the business, and not to abdicate these things that I just talked about to your CPA or bookkeeper. I have a CPA, amazing CPA. My CPA's job is to save me money on taxes. My CPA's job is not to teach me how to make more profit. So I look at my books because I'm maximizing my profit per month, and then I'm working with my CPA is like, hey, do we structure things a certain way so I can save more money on taxes? But it's profit before taxes. I see so many entrepreneurs thinking I want to have more tax savings, and they're robbing their profits and how much money they're paying themselves trying to save on taxes. The primary strategy shouldn't be saving on taxes. The primary strategy is profit, and then taking advantage of tax code to save where you can. So that's what we want to do. And then with your bookkeeper, to understand with a bookkeeper, bookkeepers aren't building wealth. Most bookkeepers aren't making a lot of money. It's more of an administrative position. It's probably a $20 to $30 hour position in the US. You can get bookkeepers overseas for a fraction of that. And why I'm saying that is because it's not a high dollar per hour job. It's a skill that gains just a certain amount of value in the marketplace as far as what that type of work is worth. So if you're making $100 an hour or $500 an hour, you're not going to abdicate all of your books to somebody making $20 an hour. You'll work with your bookkeepers, but your bookkeepers are to be like an assistant to help you to do the administrative pieces and do a lot of, just the different banking things that you don't want to do. But it's like having an administrative assistant that helps you and you delegate some things to, but you don't abdicate. You wouldn't abdicate your business over to your assistant, just like you don't abdicate your books over to your bookkeeper. If it was valuable, subscribe if you haven't done so, but give me a comment if you have any questions, put in a like, and share it with somebody that you think this would be helpful. All right, have a great day.